Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Now, today we are sharing the personal story of a property investor who started young, buying his first property around 21 years old, to the point where he's grown a portfolio of 6 properties and has still got a long way to go. We're talking to mortgage broker Bill Childs from Limitless Lending Group, and he shares his story about the properties that he purchases that he wouldn't do again, the way that he's structured his finances and what he would do differently, and where he sees opportunities for investors to change the strategy around lending and structures to help amplify their results into the future. It's a really great interview with Bill, who's very open about his portfolio and his learnings, his mistakes, and of course what he's done very well as well, getting to the point of having 6 properties in his 20s. It's an awesome interview with Bill, and here he is. Bill Childs, thanks for joining me on Geared for Growth.
No worries, Mike. Good to be here.
Admittedly, we've had quite a few chats before we hit the button, and much of that I'd love to share, but I know we're in for a great show today. Going back to 16-year-old Bill, let's talk about the mindset, where you're at, how you're going with school, what you wanted the world to be like, and what you saw your life trajectory as being. Can you cast your mind back?
Yeah, I didn't like school, and I didn't see myself going to uni. Didn't really like the study side of it or anything like that. And I just wanted to start working and start making money, save money. I liked saving money at that age, and I left school when I was 16, dropped out, whatever you want to call it, and started working full time.
Interestingly, before we recorded, you sort of shared some comments that people were sort of saying to you when you were 16, what are you doing? You're a drop kick playing with bees. So your dad had a very large established beekeeping business, or honey business, I suppose it is. So you knew that you didn't really like school. That was an obvious way for you to get out there and earn some money. And you had some ideas in and around property as well at that time, right?
Yeah, I just wanted to make money, and I did want to buy a property. That was through the guidance of my dad, which was very good advice, obviously. And I just started saving money from when I left school. And before that, obviously, when I first started working, I wasn't making much at all, but I was also living at home, so I wasn't spending much money at all either. And then by the time I was 20, I'd saved up and bought my first house. So went from there.
That's quite unusual. I mean, it's probably a little bit tacky for someone like me in their 40s to talk about the kids these days. They all want the iPhones and the Xboxes or whatever, but it is a little bit unusual to be sort of 16 years old and being disciplined with savings to the point where, after just 4 years, you had enough to buy your first property at 20. I mean, I know myself, like I was still mucking around being a nuisance at 20, but you had your head screwed on a little bit better.
Yeah, well, I was almost 21, so it was about 5 years, but I'd saved about 100,000 over that time.
Yeah,
and
wow.
It was just, I was stingy, didn't spend money on anything, and I had no costs. I don't know where it came from that I liked saving or what reason that was. I just always done it. When I was a kid, I'd get money for my birthday, I'd keep it, not spend it, stuff like that, get pocket money, I'd save it. And I liked having cash, like a wad of cash, probably wasn't much money, a few $100s, but that's where that started. And then, the property just seemed like the most, I suppose, intelligent way to put my money into something rather than just keeping it in the bank.
So you obviously had the guidance of your old man, who is a property investor. So obviously that helped you sort of get on the right path. But you're a sort of self-confessed, self-taught property investor. You're consuming podcasts and those sorts of things. Tell us about this first property that you bought. You saved a 20% deposit at 21 years old. What type of property was it? Where was it? And what did you kind of think it was sort of leading you towards?
So when I went and looked at what I could afford where I lived, which is Coffs Harbour, I couldn't get much for my budget that I had at the time, which was $400,000. And the property that I went and bought was in Tamworth, New South Wales. And I
Yep.
since sold this property. This is the only property I've ever sold because looking back, I could have done it a bit better than what I did. So I bought a 4 and 2 on about 600 square meters, and that was $390,000. But the issue with that property was that the land down the road was selling for about $120,000, $130,000. And back then, it sounds ridiculous now, but you could build a nice 4 and 2 house for just over $200,000. So if you looked at the land plus the build cost, really I overpaid. And, ever since I've looked at properties that have a higher land to asset ratio, and they've performed much better.
Yeah. Yeah. And I mean, it's easy to look back now and go, oh, well, I would have done this different, but it's all a learning thing. And I think you ought to be congratulated for, pulling the trigger and getting something done there. But yeah, that's always the worry, isn't it? It's that scarcity. Like, how scarce can it be when there's paddock after paddock? And anyone that's been out to Tamworth, it's kind of flat and there's land everywhere.
There is.
It's not all necessarily zoned residential, but it could be overnight with the stroke of a council pen, right?
Yeah, and I could have bought in Tamworth and done a lot better as well. So the mistake that I made was going for the new house that was so nice and new and shiny, because obviously all the value was in the building, not the land, which, as you know, it's the land that appreciates, or technically appreciates over time. So I could have bought for $300,000 in Tamworth in probably a better area where the land was worth $200,000, $250,000. And growth wise, I probably would have done better. But it could have been worse. Could have been an off the plan apartment, something like that.
For sure. So how long did you own it for, and did you end up selling for a profit?
Nah, I bought it for $390, sold it for $415. So didn't make a profit. If you took into account all the costs, probably lost money. But I sold it to buy. When I sold it was in 2021. So I held it for about 4 years. And I just looked at the Tamworth market was actually going all right then, but it had dipped previously. It probably went down to 350 after I bought it, and then it had come back up. This is in COVID, so the market was starting to boom. But I sort of had a look at where I thought it could go in the years ahead, and then potentially what else I could buy if I sold it and bought somewhere else. So I decided to sell it, and then I bought in Perth in 2021, which has turned out to be a much better growth story since.
You could have bought anything in Perth, I think, in 2021 and do fairly well. And then after Perth, that's when you looked to Ipswich. Is that right?
No, so I bought in Ipswich in 2018.
Right. Okay.
So yeah, bought in Ipswich in 2018 for $240K was the first one, 242. And it was renting for $300 a week, or $290, something like that. So about 6%.
Yep.
And a lot of people said, as you would have heard, what are you doing buying in Ipswich? It's a hole, Logan, don't buy there. They're dumps, whatever. And when I went there, a lot of the areas weren't that pretty either. But I was looking at it from a land asset ratio. I'd studied a lot more, listened to a lot of podcasts, and the property that I bought there was $242,000. But if I were to buy a block of land down the road, the block of land would have been worth $190,000, $200,000. So really, I was buying all the value in the land this time and not the building. And 5 years later, that property's worth $500,000 quite conservatively.
Yeah, right. And so the first couple of properties you managed with savings, but then from there you grew your portfolio, third, fourth, fifth, sixth property, essentially pulling equity from the high-performing properties like Ipswich and Perth. Is that fair to say?
Yeah, so the Perth one, I've got two in Perth, and they were in 21 and 22. They were the last two purchases. So yeah, the first one was Tamworth, and then I went to Ipswich 2018. And then from there, I pulled out equity out of Ipswich. About a year later, bought in Redcliffe. Then from there, pulled out equity out of there. And I also, I suppose it's a bit naughty, but I took some super out when you could take super out in COVID. And
the good
I
old
used,
days.
yeah,
I even there's a guy that listens to this show, I think,
yep,
who's an accountant who took
yep.
Super out to do a kitchen reno. That's the most unaccountant thing I've ever heard.
Horrendous. Yeah, well, yeah, if I looked at it, I took out $20,000 and I bought for 360. That was another one in Ipswich, 1,000 square meters, side access, can leave the front house there and build at the back, all that sort of thing. And I probably put maybe $60,000 into that, roughly, which obviously 20,000 of that was from the super. And that today's worth probably 650,000, if not more. So if I look at the ROI on my 20K, what it would have done in super versus what it done outside of super in a property, you can't be too mad.
No, absolutely not. Now you of course got you got to sort of this point where you've got the fairly good portfolio of properties. I mean, you're in the top 1% of property investors as still a young man. On top of that, a fairly reasonable salary through the B stuff, which you're still doing, and also a strategic mortgage broker as well, to the point where your income, I mean, it's up to you how much you want to share about that, but it's a lot higher than average, yet you reach this position where the banks don't want to play with you anymore. Can you tell us about that?
Yes. So I've got 6 properties now, and I've got about $2.3 million worth of debt. The issue that I'm having is I bought all my properties in my personal name, which, as we've spoke about, if I could go back in time, I definitely wouldn't do it that way. But when I was buying properties, I'd heard about trusts and companies and buying through them and stuff like that. But I found it really hard to find accountants and mortgage brokers that firstly knew about it and knew that it could be done. And secondly, if they did know that you could buy in a company and a trust and whatnot, they would say that there was no borrowing capacity advantages to it. So I'd say, oh, well, okay, I can't do it. I'll just keep buying in my personal name. If I knew what I know now, I would have structured it very differently, and all my properties would be in a trust structure, because at the moment they're about $50,000 a year cash flow positive. But when the banks run their assessments, because of the interest rate buffers that they put on my properties, which currently they're fixed at 4% still, which is very lucky, but I need to make over $300,000 a year to keep going. Whereas if I had them in a trust and I was making 100 grand, I'd find it very easy to keep going.
And you sort of mentioned to me previously that you essentially became a broker because you couldn't find anyone good enough to help you with this kind of advice. And this sort of seems to be something that's, carrying through with your life, in that you moved into broking because you thought, gee, like there's a real lack of information to help investors like me, and then also in the property space as well.
Yeah, I got into it out of frustration, really, because I was stuck lending wise and I wanted to buy in trusts, like I said. And I couldn't find anyone to help me. And I thought, I'm going to do this course. I didn't quite realize how much was involved in actually getting set up and being a broker. And I just thought I'll do this course and I'll do my own loans, be able to talk to the banks about the structures and stuff that I want to be talking about to figure out how I can move forward for myself. And then it just sort of, I got qualified. I'd done a loan for a friend, another friend. And next thing I was getting referred to people. And yeah, now that's turned into a bit of a business, which has sort of taken off. So,
yeah, awesome. And you're very big on TikTok, we should say as well.
TikTok. So yeah, TikTok's good. I'm getting, as I told you off air, probably 70 to 80% of my leads now through TikTok. So
there you go.
Yeah, I didn't think that would happen. I just started posting on it about 10 months ago and said I was going to post every day and see what happened. And I did. And for the first 30 days, nothing happened. No one cared. And then I just had a couple videos that took off and it's gone from there.
Yeah. Wow. Well, make sure you follow Bill Childs on TikTok.
Now,
when it comes to broking, there's a number of, I guess, situations where you kind of think, geez, if I'd only had the right advice, I would have structured this differently. I would have changed things. So going back to to when you first purchased that property in Tamworth from a structuring point of view, what would you have done different that you think would have actually kind of accelerated where you are, or at least put you in a position now where your powder's dry and you can continue to purchase?
Well, all I would have done different was put them in a trust. And it's different for different people, and it's different for different people of different ages. If you're 20 years old buying your first property and you know that you want to build a multi-property portfolio, 5 to 10 plus properties, then the best way to do that's through a trust. If you're 40, 50 years old, and you want to start building a portfolio, you're not going to have the same benefit as someone that's a lot younger. So it depends for each person and their personal situation. But yeah, for me, I definitely would have got into the trusts as soon as possible. And I would probably have more like 8 to 10 properties now, not stuck at 6.
Now, trusts, there's a lot of nuances to trusts, and if you speak to an accountant, they'll talk to you all day about things like CGT exemptions and loss positions and whether they can reduce income or whether they're carried forward. You've actually had conversations with accountants who represent a client in common. So let's say an investor comes to you and they're like, Bill, this is what I want to do. And then they go to the accountant to formalize this trust structure. And you've actually had some kind of, I guess you would say, disagreements or arguments or some please explain moments. Where do you see kind of an issue around, say, what might be the perfect outcome for an individual property from a strategy point of view, and where that kind of conflicts with the greater, well, this is just one of 5, 10, 20 that I want to grow? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, so the thing and the conversations that I've had, issues or sort of disagreements around with accountants, most of the time have been resolved and we end up agreeing on the same outcome. But initially, from an accountant's point of view, for example, I had a client a few weeks ago come to me and they wanted to buy in a trust. And I said, yeah, this suits you after looking at the rest of their situation. And then they went to their accountant and their accountant wanted to speak to me because they thought buying in the trust was a bad idea. So my first thought was, okay, why is it a bad idea? What are they going to say? And the accountant said that, they wanted to make me aware that the client can't distribute the negative gearing from the trust to their individual name when the property is bought in the trust, which the property they were looking at was negative probably $5,000 a year. So I had a conversation with the accountant and basically I said, if this property is negative for, $5,000 a year for the first 3 or 4 years, yes, you're going to be down 20 grand of negative gearing, which then if you obviously write that off at your marginal tax rate, that might be 40%, you might be down $8,000.
Yep.
But if putting it in that structure allows the client to buy another property for, say, $500,000 after 3 or 4 years, and that property grows in value at 6% for the next 20 years, the client's property is going to go from 500K to 1.6 mil or so. So you got to think, what's more advantageous to me? Losing, $8,000 worth of potential tax back or gaining 1.1 million over the next 20 years, and not a very hard sell to figure out which one that they went with.
Yeah. And the accountant's 100% correct, of course, but it all comes down to sort of the strategy. And I wonder if, accountants can be looking just, okay, well, this transaction, this is the way to do it. But that's kind of where you need to take your consultants and your, trusted partners along for the ride and say, here is what I'm trying to achieve. Because I think accountants, to give credit where credit's due, are very gifted at making people set up structures and set themselves up to minimize their taxes and of course protect their assets as much as possible as well, but without kind of having that grand vision of what you're trying to achieve and bringing them along the ride. I mean, they can't give you the best advice, right?
Yeah, I think you need to find an accountant and obviously broker, and goes to everyone that you use, buyer's agent, that's doing what you want to do or has done what you want to do. So, the accountant that didn't like that strategy didn't have any properties. Whereas I know accountants that refer business to me because they know that I specialize in this strategy, and it's also what they're doing for their personal properties because they understand it and they realize the benefit. So it's just down to your advisors and picking the right ones, I think.
So the default kind of wisdom for property investing, even if you say to your accountant or perhaps even your broker, I want to build a portfolio of, 2, 3, 4, 5 properties, they would typically say, well, the first one will be in your personal name. And then later on, you can establish the trust, because there's costs involved in establishing the trust and ongoing management fees with, not like self-managed super fund, but obviously there's returns that go with it. It's interesting to note that you said like from day one, you basically would have gone trust rather than a personal name. What's the reason for that explicitly from a broker's point of view?
Yeah, so I would have done that for myself, but again, it's different for everyone else. So if you have, say, a large income, say you're on $200,000 income when you start per year, well, you can probably buy 2 in your personal name or 3, and then still have plenty of borrowing capacity there to go into the trust at property 3 or 4. But if you're starting out on a low income, 40, 50 grand, which I did, you don't have much excess borrowing capacity. So you want to take advantage of all the structures that can help you out there as soon as you can. So, if you're earning $1 million a year, you don't ever need to go into trusts. There's levels to it. But if you're on an average income and you want to build a sizable portfolio, this is the way that makes the most sense over time.
It always sort of strikes me that the buffers that are put on top of the interest rates as well, that they're flat, whether it's the market's pricing in imminent interest rate cuts or rate rises. So it's kind of like undercooked when we're in a rate increasing cycle, and then overcooked when it's clear that there's only one way to go. I mean, up until recently, it was clear there was only one way to go. Now there's some talk about it potentially a rise before we get a cut. But, Treasury have sort of said, look, we're trying to get inflation back down by the end of the year. So they have a bit of a different view. But that's just kind of one example where it just seems quite unfair that there's this arbitrary kind of level. And I mean, at the moment, the RBA's minutes recently just came out and they talked about, well, we are probably higher than neutral rates. So we're talking about serviceability buffers that are actually really, really quite high interest rates. Do you see that changing at any time with APRA, or is there anything that you see some loosening happening or perhaps should happen?
Oh, hopefully it happens. I mean, there are some lenders, some of the non-banks, second tiers, third tiers that are using a 2% buffer instead of 3%. And then, as you've probably heard of, there is lenders that are doing a 1% buffer on refinances, not 3%. But I think, when interest rates were 2%, 3 years ago, 2.5 years ago, it made sense to have a 3% buffer in place. But when you're getting investment loans, especially investment interest only, if it's a high LVR, you might be at, if you're at 90%, you might be at 7.2, 7.3% interest rate. They're pricing in 10.3%. It's pretty, if we got to 10.3, I think we'd be in a bit of trouble.
There'd be blood in the streets, I think, Bill. That'd be a real worry.
Wouldn't be good. So it would make sense to reduce them, but whether that's going to happen or not, who knows?
It also begs the question, when we're at a point where, national vacancy rates are at 1.1%, depending on which month you're looking at, how much rental income the banks are considering when they're looking at your serviceability? I mean, I've heard numbers typically around they'll take 80% of your rental income. How do sort of banks vary on that side of the equation?
Yeah, most are 80%. There's some that will take 90% of rental income, but it's not only that that kills you for servicing. So when you go for a loan from the bank, if you've got, $1 million worth of existing debt and you're applying for a new loan of 500K, they're going to assess the new loan. Firstly, they're going to shade your rental income on your new loan plus your existing properties by 80%. If it's a good lender, 90%. But then it's the interest rate buffer that kills you. So they're going to put 3% loading on the interest rate that you're applying for on the new purchase, but then they're also going to load your existing $1 million worth of debt with a 3% interest rate buffer. And that plus the rental shading is what kills people.
Geez, they just take the fun out of it, really, don't they? The banks.
Yeah.
What? So for people that are listening that are either at that kind of point where serviceability is tapped, or they're really running pretty close to it, what's the best advice from a broking point of view that you would give to them to try and help them so that they could keep going?
The best advice if they were close to being tapped out? Yeah, it would be if you got some borrowing capacity left, then it would be to look to go, again, we keep saying it, but into the trust structure. Trusts, as you would know, usually have a corporate trustee. That's how it works. So you have a trust with a corporate trustee, and that way we can exclude the next lot of debt from your personal borrowing capacity assessment once that entity is profitable.
So that in that way, it's kind of like the deal on its merits rather than what have you already got, then the deal on its merits.
Yeah, well, there's other things as well. Like, for example, if someone's got an existing portfolio, I have seen a few times where they've got a few $1 million worth of debt, and that might be across 4 or 5 properties, but they've got a 15-year loan term on that or 17-year loan term on that because they've had it for a quite considerable amount of time. So if we are to refinance that existing debt back to a 30-year term, that's going to significantly reduce their repayments. And if we can reduce their repayments there, plus go to a lender that might take 90% of rental income or something like that, or won't assess their existing debt at 3%, will only assess it at 2%, that might be the difference between being stuck and being able to get another property. And if you pair that with putting the new property into the right structure, well, another year's time, 2 years' time, when that first structure is profitable, you may be able to go again. So you really need to explore all your options. If you've got a portfolio, there's a lot of levers you can pull to keep going. It's just you need to have someone that is willing to look into things for you, which is easier said than done.
Yeah, sure. And I guess the stats still say that the average investor only owns one property. And I think there's a fairly strong argument to say perhaps one is not enough to live the retirement that you want to live. And for a lot of people, and I presume listeners of this show, they want to push it as much as they can or as much as they're comfortable. And typically that is, 3, 4, 5, 6 properties. I don't think you need 10 or 20 properties to retire comfortably. No. You could just have 2 really good ones, right? But once you're getting to that point, I mean, of course, it depends on the income that you have. But if you're on an average income and you're looking at that, 1 or 2 property mark, you can probably achieve that, would you say, in your personal name? But anything in excess of that, that's where you need to get a little bit creative with the structures.
Yeah, you can achieve 4, 5, 6, probably 10 properties in your personal name. It's just going to take longer than if you go down the route of structuring it correctly, as we've been speaking about. So,
yeah,
you might buy 4 or 5 properties and be tapped out. If your income's decent, you'll be able to get 4 or 5 properties, but then you're going to be tapped out. 10 years from now, it's a completely different ball game because your rents may have almost doubled. Your interest rates might have come down. You've paid down your debt. Again, you might be able to refinance your loans from 20-year back to 30-year. Your income's gone up. You'll find that you'll be able to buy again, but you'd prefer to buy again in a year's time rather than 10 years and get that added 10 years worth of capital growth if you can.
Now, I've heard property investment specialists say get rich slow, but what they're talking about is the power of compounding and growth over time, not go slow when there's an option to speed it up and achieve those results faster, right? That's not what they're talking about.
Yeah, well, you definitely buy, if you had the chance, you definitely buy 10 properties in 1 year as opposed to one property a year for 10 years if you could, because then you'd have 10 properties compounding at 6 or 7% over the next 10 years versus accumulating them over that time and at year 10 not having anywhere near as much growth.
Exactly. And $1 today is worth more than $1 tomorrow. And then, of course, you've got that leveraged effect. So that makes perfect sense to me. What about you, Bill, and the future? What are you aiming for with your personal situation and your portfolio? Give us a bit of an insight into what we can expect to see if we're following you on TikTok.
Yeah, that's a good question. I'm not sure. I got a bit going on. I am bringing on another broker now in the business. So I need to get this business running smoothly because I'm getting, as I said to you off air, a lot of leads, more leads than I can handle at the moment. And I didn't want to bring on someone that also, I couldn't just bring on anyone because most of my leads come to me because they like, well, my story, really. They say, you've got 6 properties. I want to get the same or more. Teach me how you've done that, more so than they come to me needing a loan, because there's 18,000 brokers in Australia that can write you a loan if you want a loan. But they come to me more for a bit of, I suppose, guidance as well. So I've got a broker coming on that's also got 6 properties, and he built that starting on a very low income, working 2-3 jobs for 10 years. So hopefully get him on board and we can work with investors that are wanting to do the same as us. And look, through that, the business is going well. I'm making money. That's probably going to keep growing, hopefully. And then, I'll continue purchasing once I have the income at the right level, which hopefully will be after this financial year. And we'll see what happens. I got equity there that I can use. It's just at the moment I'm tapped out lending wise again because of my structuring. So make money, get the business running, buy more properties, really.
Get the trust established and off to the races. So, Bill, I was just about to say there's no shortage of brokers, right? So it begs the question, why are the leads? But I guess it's connecting kind of the aspiration to the utilitarian stuff, which is I need a loan, but the loan needs to kind of fit into the strategy and the overall focus, right? And that, I guess, is why people are reaching out to you. It's because they don't just want a loan, they want a portfolio, and there are things that a broker can do to make that achievable, or on the other side, make it impossible.
Yeah, exactly. I mean, if you want to buy your first home, there's 18,000 brokers in Australia that can get you that loan. Most of them will do a pretty good job. But yeah, if you want to buy 4, 5, 6 properties, how many of that 18,000 brokers have 4, 5 plus properties? I don't know what the number is, but it wouldn't be very large. So it comes back to the point of wanting someone that's done what you want to do. And I think that's why I get most of my leads. It's purely through that. It's not because I'm marketing the best interest rate or telling them what LVR means or something like that, which I don't think is the best way to go about it. Trying to beat the rate that CommBank has and refinance them or something like that, the retention team from CommBank's just going to come back and beat you anyway. So yeah.
I think that's good. That's good. We need people in this property space. We need good brokers. We need good accountants, and then hopefully we can move the needle on that stat that the average investor only owns one, because we want people to live financially free, and they might need more than that to do it. Speaking of which, if people wanting to get in touch with you, Bill, what's the best way to do that?
Mate, Instagram or TikTok is probably the best way. Billchilds LLG. You'll find me on there, and send me a message. We'll have a chat and book in a time to have a call and see what we can do for you.
Awesome. Bill, thanks very much for sharing your insights, your wisdom, and your story today. It's been a pleasure.
No worries, Mike. Thanks for having me.